Good morning and welcome to the Frostrow Capital London Investment Company Seminar for 2022. My name is Khan Vu and I'm from VinaCapital. Today I'm joined with Andy Ho, Chief Investment Officer at VinaCapital, as well as Michael Kokolari, Chief Economist at our firm VinaCapital. Today we'd like to talk to you about the VinaCapital Vietnam Opportunity Fund, our London-listed FTSE 250 investment company. The one that's been around for the past 20 years, and our focus has been on investing into private opportunities here in Vietnam. Today, as part of this update, we've been delighted to be able to physically be in London to present. It's been 3 years since the last time Andy and myself have been able to be in London to present at the Frostrow seminar. And for those that aren't able to make the physical presentation, we thought that we'd have a video presentation that we would record for you. Today we want to cover off 3 parts as part of this update. Number 1, why Vietnam? The second part we want to cover is why VinaCapital. And the third part is why the VinaCapital Vietnam Opportunity Fund. VinaCapital is a very well recognized financial brand in Vietnam today. Andy, the firm has been around for almost 20 years. We have today about 4 billion of assets under management. Can you talk a bit about how we've been able to grow and our success over that time?
Yeah, sure. So VinaCapital is founded by a number of folks that are that are rooted in Vietnam. The CEO, Don Lam, is Vietnamese. I am Vietnamese as well. I've been with the firm since 2007. Don started the firm in late 2003. So we have a lot of experience in Vietnam. Needless to say, we're Vietnamese, and the experience that we've had is what we can apply to the investments that we make today. And these experiences, and obviously the mistakes that we've made, is part of the knowledge base that we have to make good investments going forward. The areas that we focus on are primarily Vietnam. We don't invest outside Vietnam, but we like to invest in assets such as real estate, private equity, public equity, fixed income, and venture. These are the various asset classes we have. An example of large projects we also take on is a $3.5 billion LNG to power with a large Korean conglomerate. We also have a joint venture with a large US PE firm to do hotel investments throughout Southeast Asia. And we also have a large joint venture with another big US private equity firm to do clean energy investments in Vietnam. So our focus is Vietnam. We invest in various asset classes in Vietnam. We have many, many years of experience, mistakes that we've made. We've learned from it. And in fact, you can buy a book that the firm publishes called Crossing the Street, and it demonstrates our ability to navigate some of the challenges that we've seen over the years, and hopefully we can use that experience to make good investments in the future.
Mike, today we're operating in a very interesting environment. I think one of the things you normally say is, may you live in interesting times. We're in a world where there's inflation risk, there's policy change risk, and there's also geopolitics. Perhaps if you can help sort of share with us your views on inflation risk, and in particular why Vietnam so far has not been seeing the levels of inflation as we have in developed markets.
Well, inflation in Vietnam is below 3% right now, which is much lower than many places in the world. Of course, everywhere in the world, the 2 main factors that are pushing up prices are higher oil prices and higher food prices. In Vietnam, retail petrol prices are up nearly 50% year on year. And actually, this is the main thing that's pushing Vietnam's inflation rate up. Food prices are only up 1% for a couple different reasons. One of which is that, as you kind of alluded to, we do have the situation in China, the lockdowns, et cetera. And that is kind of keeping a lid on food prices in both China and Vietnam. China also has quite low food price inflation right now. So, yeah.
Thanks, Mike. So it seems like at the macro level, inflation is very much under control in Vietnam. Andy, turning to you, perhaps at the individual business level, are you seeing inflation pressure impact?
Yeah, thanks, Ken. I think we just need to make one clarification. Although oil and gas prices have gone up, it makes up a very small component of the inflation basket that we see in Vietnam. But for specifically for some of the businesses we invest in, the obvious area that there has been an impact is in the confectionery space or the food and beverage space, particularly those companies that have to source inputs, materials that predominantly comes out of Eastern Europe, such as wheat and corn. So some of these businesses are facing higher costs of input. But by and large, I think most businesses are doing quite well, and inflation is not really having a major impact on these businesses at the moment.
Right. Thanks. Mike, you talked briefly about China. China obviously, and the lockdowns in China, has been making quite a bit of headlines. But pre-COVID, we'd already heard of this idea that many businesses were moving away from China to Vietnam. And you also hear this narrative at the moment that Vietnam is like what China was 20 years ago, the opportunity set, the investment opportunity. Can you sort of talk briefly about the relationship that Vietnam has with China? Is it, with the slowdown in China, is it going to have an impact on trade, on our imports?
Yeah, that's a great question, because this is something very much of concern to a lot of emerging market countries. And it's actually less of a concern here in Vietnam, because Vietnam, of course, China's our big neighbor right there. We have a lot of trading relations with China, but what we don't have is we don't sell a lot of products that ultimately get sold to Chinese consumers. So the slowdown in China's economy doesn't really impact us so much. What we do need to be careful about is that there's a lot of trade back and forth between China, where Vietnam sources a lot of production inputs, capital goods, things of this nature that we use to manufacture products that we then export basically to the US and to the EU. So were the lockdowns to continue and were supply chain issues to persist for another maybe 2-3 months, something like that, it could be an issue for Vietnam. But currently, we haven't really seen much of an impact on factories here in Vietnam sourcing production materials from China. Not an issue yet, but it could be in the future. We're keeping our eyes on that.
Right. So Andy, to continue that, it sounds again like there is minimum impact from a macro point of view. What are you seeing in terms of the earnings for companies in general, and specifically for companies in our portfolio? Are they being impacted, or actually are we seeing this idea of a recovery in earnings?
Yeah, when it comes to the financial performance, it's key that we let the audience and the investor know that we do report in US dollars. So there's an element of FX. And what we've been seeing is, fortunately, the local currency against the US dollars have been very, very stable over the last 3-4 years, for that matter. And as a result, the performance that we are seeing in these businesses, particularly as we live in a world of post-COVID and living with the COVID in the society, we are beginning to see businesses come back to life effectively. For Q1, for example, the performance that came out of Q1 for companies in the Ho Chi Minh City Stock Exchange, they've shown growth in terms of EPS to the tune of about 29% relative to Q1 of 2021. I think the key here is that our head of research believes that for the rest of the year, 2022, the growth would be around 20 to 25% in terms of earnings per share.
Right, great. So I think if you look at our portfolio, Andy, similarly we're seeing growth in excess of that level. I mean, at the moment, our portfolio, we're looking at growth of about 35 to 38% earnings growth. I guess a testament to the quality of the companies that are in that portfolio. They've been very resilient during COVID, and now out of COVID, they're obviously benefiting significantly from this recovery. Mike, perhaps turning back to you again, Vietnam's growth in general. You heard Andy talk about strong earnings growth in Vietnam. How is that going to translate to GDP growth for this year? And in particular, what sectors should be benefiting from this?
Yeah, that's a great question. I expect 6.5% GDP growth this year, and the key is that it's really being driven by the domestic economy. So we've seen that COVID and the Omicron variant really peaked in March, and the number of daily new cases has just plunged. So COVID is basically behind us now, and that's had two things that benefit as a result of that. One is that consumers are rushing back, and there's kind of a pent-up savings that they want to spend in restaurants and consumption products. And the other is that people are going back to work in the factories, so their incomes are they have enough money to. So either the upper middle class people are spending judiciously on consumption goods, or the people that are laborers, they have sufficient income that their consumption is also able to rebound. And so it would be really the sectors that banking, consumer. We'll see some infrastructure development happen as the government's fiscal stimulus program gets enacted, and that will also benefit. But those are the main areas to focus on. Yeah.
Right. So this consumption-led story is still very strong, and like you say, there's an amount of savings and almost perhaps even amount of revenge spending.
Revenge spending. It is happening.
That is happening. Andy, are we seeing that translate to for example, we've been traveling a lot. We go to the airport. There's a lot of people at the airport at the moment. There are tourists now coming back. Where are you seeing Vietnam opening up in like this?
Yeah, like Mike said, the sectors that contribute to the growth of the domestic economy or benefit from the growth of the domestic economy will do well. And predominantly, those are the sectors that provide goods and services to the consumers, whether they're in banking, food and beverage, etc. One of the key interesting things that we're seeing is the business activities have sort of come back to the pre-pandemic level. As an example, when we look at the airlines business, for example, a lot of the domestic flights, the volume of domestic flights that we're seeing at the moment is at the pre-pandemic level. So that's really exciting. The people in Vietnam have money. They're going to spend. They're going to go on vacations during the weekends and holidays. And the business activity is quite vibrant at the moment. So in short, we are focusing on companies and sectors that benefit or contribute to the growth of the domestic economy.
So sticking with you, Andy, then perhaps you can maybe share with some of the things that are in our pipeline, right? What are some of the opportunities that we're looking at? Do they involve these sort of sectors that are going to be benefiting from this growth?
Sure. The items in our pipeline right now, we're looking at about $250 million or more of opportunities to invest. Again, like you alluded to earlier, our investment strategy is to find private opportunities, negotiate terms of investment such as downside protections, board rights to sit on the board of directors, and some sort of exit rights to get the company to list on the stock market or go to a trade sale. And so we typically deploy $40-50 million into these businesses and ask for private terms before we make the investment. And at the moment, we are negotiating about 5 opportunities with over $250 million of capital to deploy. And it's in areas that are associated with the consumer space. One, logistic business, travel businesses, food and beverage businesses. So we're quite excited about that. And the key here is really, we are looking for businesses that grow at least 3 times that of GDP growth. And as Mike alluded to earlier, if we're growing at 6-7%, we like to see the business that we invest in grow at least 20% or more.
Right. And I think, just to put it in some context, it's not all rosy. We've obviously seen quite a bit of volatility in the markets in the past quarter. Andy, perhaps explain a bit more. Why is it important that our strategy and the terms that we negotiate, though I think you say a lot, these downside protections, why is it particularly important in this environment we're in at the moment? And from that, where do you see the market direction, the economic direction in the short to medium term?
Yeah, I think in hindsight, if we look at the activity starting early 2020, we saw the markets during the last 2 to 3 years became extremely volatile. And it's happening in the US, Europe, as well as Vietnam, because Vietnam is getting more and more integrated into the global community. So Vietnam is feeling the effect of global volatility. So last week, for example, the US markets went up and down 900 points, 1,000 points. Vietnam will go up and down as part of that. And so what we found is, as part of that volatility, Vietnam will probably be affected. So as we approach our investments on the private side, we tend to ask for downside protection. That gives us a minimum IRR, a minimum return, anywhere between 15 to 17%. So if all things happen the way it's planned, then we should make a higher IRR, let's say 25, 30%. But if market conditions in the next 3, 4, 5 years is not so positive and markets came off, we still have what we call minimum return downside protections. It typically comes in a form of a put option. We sell back the shares to the sponsor, to the company, because market hasn't done well, or the performance of the businesses, the revenue commitment or the profit commitment haven't come through. And as a result, we would ask that they buy back the shares from us at a minimum IRR. So that's sort of what we view as a downside protection in our investment. And as you can imagine, when we ask for this downside protection, in many cases, they ask for a sort of a cap on the return, which we're happy to give because we feel that in this moment of volatility, we rather deliver a stable, consistent return around 20%, 20 to 30%, than try to hit a 40, 50% return. So we're happy to adhere to some sort of cap that they would ask for. But by and large, when we do accept a cap of, let's say, 30% return, we do ask for a little bit of equity upside in terms of an option to buy the shares or a warrant associated with the investment. So we do ask for a little bit of equity upside, but by and large, if we ask for downside protections, then the sponsors tend to couple it with a cap on the upside, which we're happy to accept.
Perhaps to illustrate, I mean, last year we completed a transaction which was in this sort of structured investment space. That downside protection, that put, and then there's a call. So I guess we have a certain level of return that we can expect. You did one of those last year. I mean, I think it was in the real estate sector.
We've been fortunate to be able to do quite a few of them as of late. So the one you're referring, we call it Project Norfolk. But it's an investment where we deployed almost $100 million, and we asked for a minimum return of 17%. Along with that structured product, it's a 2-year product which comes to a conclusion or maturity at December of 2022. But along the deployment of $100 million, we have an option to buy into the shares of the company. The option is to spend roughly $25 million to buy into the shares of the company at the prevailing price of the date we enter. So since the date we enter the investment, the value of the company has doubled. Right, it's gone about $3 billion to over $6 billion already. So as you can imagine, the option to spend $25 million is significantly in the money. And the counterparty for the option is the company. So what we negotiated was, a few months ago, we negotiated to sell back the option to the company so that their liability doesn't get larger and larger as the share prices move up. So we were able to realize the gain by selling them the option back. And then at the same time, we took that proceeds and reinvested back in the business, earning 17% IRR. So for the blended return for this investment after 2 years, that concludes in December of 2022, the blended return would be around 25%. This is a typical structure investment where we have 25% opportunity to enjoy the equity upside, while 100% of the investment has downside protection, minimum return of 17%.
And once again, sounds like a very sensible thing that you did, given the recent volatility in the market. I mean, last year we saw Vietnam was in the second year in a row, I believe, the best performing market in the region. Obviously, the first quarter this year, we've seen a lot of volatility across global markets. Similarly, in Vietnam, we've seen actually a contraction in the market year to date. So being able to lock in that 25% return for our investors throughout this period of volatility seems very sensible. But you also did a recent divestment. We've just disclosed to investors one of these divestments. And in light of the volatilities that we've seen, it seems to be able to very successfully exit a company. It's, I believe, one of the largest PET packaging companies in Vietnam. Can you talk to us a little bit more about how you sourced that investment, how we got into that, what we did during that period of investment, and then how we were able to exit?
Sure, sure. About 3 years ago, we took a meaningful stake in one of the largest PET bottling company in Vietnam. They produce the bottles that you would drink Coca-Cola out of or Pepsi out of, and it's a plastic bottle. And the rate of one of the issues we thought through was an ESG issue, using plastic bottle. But we felt quite comfortable because the recycling rate in Vietnam is extremely high. It's like 99%. So Vietnam as a society is able to recycle plastics and papers, etc. So these bottles were easily recyclable, and the plastics were turned into pellets and used for other means. Right? So we made an investment in a business which had a very weak capital structure. We had to restructure their capital. In other words, fix their debt structure. They were borrowing too much money. We had to refinance their balance sheet. And we also acquired more new machinery and equipment that was more environmentally friendly, and it can also take on recyclable pellets to produce PET bottle. So we've done a number of things, and about 2 months ago, we completed an exit of this investment to a trade buyer, one of the largest PET bottling company in the world. They are based out of India/Thailand. And they're actually a public company. They made the announcement. The company is called Indorama. But we've been very successful in exiting this business through the fact that we were able to restructure the balance sheet. We bought new machinery and equipment. And we sort of proved to the strategic buyer that in the long term, this is the best asset they can acquire in Vietnam relative to them organically building a similar business in Vietnam. We said, well, by paying this valuation, this price, which by the way, allowed VOF to return 21% IRR over a period where the stocks have actually gone up, but over the last 12 months has been flat, right? So we've delivered 21% IRR on this investment, but we're able to convince the buyer that it was better to acquire this business than to organically grow this type of business in Vietnam.
Yeah, and I think that's a really interesting point you make there, Andy. This strategy of us being able to identify private opportunities, negotiate and lock in those returns, we've been able to deliver a 21% IRR in a period where the stock market, has, yes, certainly gone up, but also gone down, and in fact over a similar period has been flat. So again, as long-term investors, we're investing to companies and we're looking to deliver long-term performance. I'm going to turn it back to Mike first, and then we'll sort of round off with Andy to close out. Mike, the competition for investors' money, there's a lot of that within emerging markets. Why should investors think about Vietnam in their allocation to emerging markets, and what makes it so? Why should it be part of it?
Well, I think the first thing, which has been consistent for years, we've always been telling investors, is that this country, perhaps together with India, are really the two most attractive long-term growth stories, with fairly simple growth drivers like urbanization. Less than 40% of the people live in the big cities. FDI, about 6% of GDP every year. Lots of FDI flows coming in, building factories, emerging middle class, and that hasn't changed at all for years. What I would say is new over the last couple years is that Vietnam is getting a lot more recognition as this is the place to come and set up a factory. We have this new Lego factory is setting up their first carbon neutral factory, and it's a $1 billion investment. Well, okay, this $400 billion economy, but that will by itself attract a lot of other long-term investment here. So that's the kind of medium long-term growth story. And in the short term, as I mentioned earlier, a lot of countries have problems with inflation, with big depreciations of the currency, given everything that's happening in the U.S., and we're not really having that right now. So both from a long-term point of view and a short-term point of view, this is really probably one of the best places in the world to put your money right now.
And I think just to add to that is that we have a very stable political system.
Sure.
And in the region, we've seen, particularly in emerging markets in Southeast Asia,
right,
recent changes in political systems. Sure. So
particularly in Southeast Asia, yes, a lot of turbulence.
Right. So for investors, they're getting all of these benefits. So just to round off perhaps the conversation today, why VOF, Andy? What's unique about this fund, with other Vietnam opportunities that are out there? why should investors consider a single country specialist like us?
Yeah, I think VOF offers a very unique opportunity for shareholders to access Vietnam. The fund is about $1.4 billion. And the uniqueness is that VOF is pursuing private opportunities, large private opportunities. It's akin to the Berkshire Hathaway in the United States, right? We're looking for really high quality businesses, but we're not picking stocks. We're not buying 1, 2, 3, 100 shares here, 100 shares there. We are actually deploying $40 to $50 million into private business as well as public businesses. And we're helping these businesses grow over the next 3, 5, even 10 years. Being listed on the London Stock Exchange give us the ability to invest for the long term, rather than some of the private equity funds where they have a life of about 5, 6 years. We are able to invest 10, 15 years in some of these businesses and watch it grow. For example, the largest steel company in Vietnam, we invested when it was about $400 million in value about 10 years ago. Today, it's about $7 billion in value, and we've made significant return on that investment. So the point being is we're able to take private positions, negotiate private terms into large businesses in Vietnam, and we allow our investors to access that type of opportunities. And at the end, we are the only fund that pays dividend. We pay dividend based on the profits of our investment, whether the profits come from the dividend that the companies pay to us or the realization of exiting the investment to a strategic buyer or whoever that's acquiring our stake.
So thank you, Andy. It's really clear how the fund, VOF, differentiates itself. And through that approach to private investment, we've been able to deliver long-term performance to our investors. For example, over the past 3 years, we've delivered 75% return. And importantly, during this period of volatility, we're still able to track ahead of the index and other peers. So today, we want to thank Mike, Andy, for being with us at the Frostrow Capital London Investment Company Seminar for 2022. We hope to see you soon.